Hello friends, welcome to the Mantri series. We are covering BFM PYQs, previous sessions. Very important ones. These are all repeated from the exams. So follow the video completely, share it with your friends, like the channel, subscribe to the channel, click on the bell icon. Don't miss this. Because in this channel, JAIIB CAIIB English Medium, you will be getting a lot of updates as well as free material on your JAIIB as well as CAIIB. We'll be covering some theory questions today. Many numericals I have covered in last week. Okay, so I'll be covering some theory questions now. So let's move on. Under REROC framework, which of the following statements is correct? Lender begins by charging an interest markup to cover the expected loss. Lender allocates enough capital to the prospective loan. Provision plus allocated capital covers only 40% of the loan loss outcomes. So which of them is correct? A and C, A and B, B and C, all A, B and C. Lender means bank. We are talking over here of bank. So bank begins by charging an interest markup to cover the expected loss. Do we add a risk premium to this? This is known as risk premium. Whenever you give any loan, there are two parts. In any loan, interest which we charge, interest, that interest has two parts. Not even two, in fact, it can be three also, but mainly two. First one is your cost. What is the total cost? Now this includes your NII. Okay, NII means what is my loan income minus what is my deposit income. Then second thing, it will include the operating cost. What is my salaries? What are my electricity bills? What are my provisions? All these things. So that is to be subtracted. Income, NII minus these expenses. Plus, what will I add now? Now the third part which will I add is this loss premium. Loss premium means what? Expected loss premium. What does this mean? What are the chances of this loan getting NPA? How will you get this? You get this by the ratings. Okay, the ratings which you give is here. There are two types of ratings again. One is given by the external agencies. These are for the large loans. But in your bank with a small loan, suppose if somebody has come for 50 lakhs, do you go to the rating agency? No. You will do your own internal assessment. And then you will give the rating score to that. So that score is added as a risk premium. Okay, so this will be the part of your loss premium. Means there is a chance of this much percentage of loss. So I'll add that much percentage to the interest. Okay, so this is true. What about the second one? Lender allocates enough capital to the prospective loan. Obviously, enough means sufficient. Whatever is required. Capital is required. Without capital, you can't have a loan. Right? If you have to give a loan to somebody, you need to have the money. How will you get the money? You will get the money through deposits. Number one. Number two, through capital. Tier 1, Tier 2 capital. Right? This is the way you will be getting it. So obviously, he has to allocate the funds, isn't it? T. Provision plus allocated capital covers only 40% of the loan loss outcome. It is not the case. Provision plus allocated capital. Okay, provision plus allocated capital. So will it cover only 40%? Can't I have complete 100%? Provisions. There are 100% of provisions for many of the private loans, isn't it? 125% for the retail loans. Okay, so this is false. So the answer is only A and B. Okay, A and B are true. Got it? Rediscounting of foreign bills by the treasury is done at a price more than the market placement due to which of the following reasons. So rediscounting of the foreign bills by the treasury is done at a price more than the market placement. Now, what do you mean by this market placement? Market placement means the funds which I keep in the market, in the bond market. It's not stock market, it's bond market. Funds, so funds which I keep in the bond market. So rate of interest for that bond market is, let's say, 3% or 4%. Okay, bond rate is let's say 4%. Then what does it say? Rediscounting of T-bills will be done at a price higher than. So my rate of rediscounting will be done at a higher percent, let's say 5%. So why is it 5%? Why can't it be 3%? The question is, why can't it be 3%? That is the basic question. So what are the reasons? The advances include the usance period of 15 to 365 days. Here you are doing the treasury bills, okay? And here we are talking about market placement. Market placement means basically this is interbank borrowing. You can call it interbank borrowing also. Interbank borrowing, okay? So rather than calling it bond, it's better to call it interbank borrowing, because generally that is the main criteria. Everything, your call rate, everything depends on this interbank borrowing. Bond can be for longer period also. So that's why this your rate should be higher than the interbank borrowing. The reason is, see, this interbank borrowing is generally for max to max, 3 months. Very means long item I'm talking of. It can't be more than 7 days generally, 15 days, but max to max it can be for 3 months theoretically. So that's why this is for 3 months. And this is for rediscounting of T-bills. T-bills can be for 364 days. 364. So here the tenure is bigger. So if the tenure is bigger, you will charge more interest. Right? Simple logic. If the loan tenure is bigger in any case, you will always charge the higher rate of interest. So that's what you are charging. So this is true. What about the second one? The counterparty would charge their customers a commercial rate of interest for the underlying. Is it so? Firstly, what is rediscounting of bill? What do you mean by rediscounting of bill? See, the rediscounting of bill means, suppose if there is a bank, okay, bank has given a loan to customer. So bank will give the loan at what percent? Let's say 9%. So bank is getting 9% from this customer. Now what is rediscounting then? Bank goes to, let's say, RBI. Or I'll take simple example. Na? It can be anybody. It can be NABARD also. It can be anybody. Okay. Exim Bank also. So I'll take simple example of RBI. RBI also does this, rediscounting of bills. So if RBI does this rediscounting, what rate should RBI charge? RBI also knows that this bank is getting 9% from this customer. So RBI will say, you keep a percentage of 2% to you and give me 7%. So here it was 4% interbank. RBI will say, give me 7%. Why doesn't RBI doesn't want profit or what? So RBI will say, okay, we'll settle 6%. So even if they charge 6%, then also what is happening? See, this interbank is 4% and here you are getting 6%. So obviously this is also the second reason. True. Because banks, commercial bank will charge at a commercial rate to the customer, which is quite high. So bank is earning a lot without taking in the risk. See, in this rediscounting, what is happening? The risk is taken by RBI now because the assets are transferred to the RBI. This bank will sell these assets to RBI, the rights of these assets. Okay. So that's why this is higher. So that's why obviously both are true. Both 1 and 2 are true. Okay. Which of the following is not a requirement of commercial paper? Not, kindly note, not a requirement of CP. Very important question. Very, very, very important, because this will be there in the exam always. Some way or the other they'll ask you this question. The issuing bank should have a minimum credit rating of P2. Net worth of the company should be more than 1 crores. Loan advances received from the bank should be under standard asset. And minimum issue of CP should be this 5 lakhs. So which one is not the requirement? See, not the requirement. Not. Not. Which one is wrong? Let's say, let's be very simple. Which one is wrong over here? Okay, which one is wrong? Let me see in the comment section. Which is wrong? Yes, everyone. Kindly note, P2 rating is compulsory. P2, compulsory. If you have to issue a CP, what is this all criteria for? See, understand the logic of this problem, of this question. There is a company XYZ who wants to issue the CP, commercial paper. So this A, let's write this company X. Okay, company X. It wants to issue the CP, commercial paper. For that, RBI has put a criteria that, see, if you want to issue the CP, follow these guidelines. So we are talking of these guidelines now. Now, next question which will come into your mind is, why does the company want to issue CP? Can't it get a loan from the bank? So what is a CP basically? CP means this, I am company X, I want money for running my business. So you'll say, get it from the bank. Why are you going for all these extra facilities? Get from the bank, directly get the rate, go them, give them the security, they'll give you the loan. But there's a problem. Bank has a limitation. Cost of funds of bank is high. See, I'll give you. Bank has a limitation. Bank can't give beyond certain amount. There are limitations. Okay? You can't give beyond 15%, you can't give beyond 20% to a group. All these conditions are there. So bank has a limitation. But I want more money. I am big company, Reliance, Tata. Constantly I want money. So what will I do? This is one source of money for me. So what will I do? I'll go for the another source. I'll go to the common public. Public. Now public. Now public means what? CP is not given to common public because CP amount is huge. It is 5 lakhs minimum. Minimum investment is 5 lakhs. Now 5 lakhs is not a huge amount actually. But the problem is this is not 5 lakhs. The issuance is in multiples of 5 lakhs. So you can't issue a CP for 5 lakhs. You have to issue it for 50,000 crores. And investor, this criteria is for investor, 5 lakhs. It is not for the issuer. Issuer, suppose if tomorrow you come, Reliance comes and says that, I want to issue a CP for 2 crores. Then RBI will say, what are you doing? 2 crores. Means that cost of issuing that CP is higher, isn't it, than the 2 crores. So this issuance for the issuer or this company X will always be high. Means 50,000 crores, 1 lakh crores. This is for the investor. So now coming back to this point, why will this company issue this CP? Because the cost of this issuing is less than the cost of the bank rate or this loan rate. Okay. So number one. Number two, additional capital. Bank has given you 100 crores. Now I want more 50 crores. So in that case, I'll issue the CP. Okay. So got this logic of CP? So now coming to this point, P2 rating is compulsory. What about this? This is wrong. This should be 4 crores, 4 CR. Okay, your net worth should be more than 4 CR. So not required is this answer. Loans and advances standard, so that is okay. And 5 lakhs, that is okay. Minimum investment is 5 lakhs. Now this is for the investor, commercial paper. There are two elements, kindly note, CP and CD. Commercial paper and certificate of deposit. These two are separate. Okay. Kindly check this because see, I'll give you the difference also if you want. In hardly 1 minute I can give you. I've dealt with these products on a in my daily life in banking. I was dealing with these. So kindly note, CP is transferable, negotiable. It can be transferred from one company to another, one buyer to another. CD is generally not transferable. Okay, it is generally not transferable. You can make it, but it's generally not. CD is for the retail investor, retail like you and me. I can issue the CD for 10,000 rupees also. But RBI has given for that also now. RBI said 5 lakhs minimum. Okay, so even 5 lakhs is not a big amount now. I mean, there are lakh crores of investors who can invest 5 lakhs, isn't it? So now CD is that part. So generally CD is not negotiable, CP is negotiable. Plus there are others also. We'll discuss some other time because that will take more time now. You can check this on Google also. Treasury risk can be managed through which of the following traditional methods? Traditional, look at this, traditional methods. Which of the traditional methods treasury risk can be managed? Organizational control statement, exposure ceiling statement, limits on trading positions and stop loss limits. So how can you manage the treasury risk? What is organizational control statement, exposure ceiling statement? These statements are always given by the board of directors to the treasury head. These are always decided by the board members. Okay, board members will always check this. Okay, so organizational control statement, exposure ceiling, limits on trading positions and stop loss. So all of them are correct. Okay, all of them are correct. What is all this? Organizational control statement means what is the limit which the organization can work in treasury. What is the maximum limit of the organization? Second is this exposure ceiling statement. Exposure means per customer or per bond. How much can you purchase a bond for a particular company? Otherwise, what will happen? I'll purchase the bonds for all the bonds for one company only. Treasury, let's say Tata's. I purchase all the bonds, or I purchased all the bonds for some company X, and tomorrow that company X says that no, I don't have money, gone. The whole investment is gone. Same thing we have in your loans also, no? Isn't it? Don't you have it in your loans? You can't give more than 15% of your tier 1 capital to company, a single company, more than 20% of the tier 1 capital to group. Isn't it? Don't we have this? Same thing. Everywhere the logic of the banking is diversification. Isn't it? You have to diversify your assets. Without diversification, you cannot work in bank. Okay? So, got the answer? All. 1, 2 and 3. Which of the following reasons are for high treasury risk? High treasury risk. Why do we have high treasury risk? Low funding is required due to high leverage, which may result in straight loss of capital. Large size of transactions done. In the treasury transactions, once confirmed, are irreversible and may result in huge short-term loss. So why do we require why do we have high treasury risk? Now understand few points about treasury. I'll come from the lowest one. In any treasury transaction, once you agree to any transaction, you can't say no. It's like NEFT RTGS. Same, no difference. In NEFT RTGS, if I do this RTGS, done. It is gone from my server. Can I reverse it? No, sorry. Can we bring these funds back? No, you can't bring the funds back. Gone. Go to that bank and then get whatever you want, right? You can't do it. Same thing over here. Okay? Once confirmed are irreversible. I put the button buy. Done. Even after half a second, I say that no, wrong. Gone. It's irreversible. That's why huge cost. And the amounts are what? Large size of transactions. Treasury transactions deal in the range of 500 crores, 1000 crores, 100 crores. The figure starts from crores and generally it's 100 crores minimum. So that's why this is huge. So 2 is also true. So true. Next, low funding is required due to high leverage. Now leverage is high. Very important. Leverage is high. This is 2. Leverage is high. What do you mean by leverage? Leverage means, suppose if I am having 100 rupees with me as a capital, what is the amount of assets which I can buy? That is called as leverage. Suppose if I am having 100 rupees, logically I must be able to buy only 100 rupees anything which I am having. But in banking we have this leverage concept. in treasury specifically. With capital of rupees 100, I can buy the assets of 1000 rupees. Same thing you have it in your stock trading also. Check the stock trading, day trading. Those who are doing day trading, you'll get this, right? With a capital of 100 rupees, I can do the transaction of 1000. But if I suffer a loss, full 1000 is to be paid from my pocket. I'll have to sell anything, my house. Okay? But I'll have to pay that. So same logic over here, treasury. Low capital and high assets. Because we trade, we don't keep it for long time. At the end of the day, everything is sold many times. That's trading. But it carries a high leverage, high risk. So this is also true. So 1, 2 and 3, all of them are true. Okay? So now, before going, join the new batch of Adda 24/7. We are starting with the 8th batch. Don't miss this. Okay? The 8th batch is coming up. Don't miss the 8th batch. Okay, for CIB. See this. Starting from 3rd September, check this. Starting from 3rd September, limited seats, ebooks, mock tests, online live classes, recorded sessions, everything you have. Okay? Mock tests are to the level of chapter wise and also full length. All of them. So it's like the practical exam only. Okay? And you are getting discounts. Look at the discount part. Click on buy now. Put the code Y432. Y432. Enter. 79% discount plus 1% extra through the app. Always purchase through the app. Download the app first. There you get 1% extra. One more product I'll show you. That's Increment Mahapack. One of the best Mahapacks. See this. CIB Increment Mahapack. Purchase this. Right now you are getting double validity on it. Double validity means you buy for 6 months, you get it for 12 months. You buy for 12 months, you get it for 24 months. Huge. Plus 80% discount, 79 plus 1. But what do you get in this Mahapack? You get 15 plus batches per subject. Then you get physical books, question bank, physical question bank for all the compulsory subjects. Plus you get ebooks. Ebooks also you have. Plus you get formula bank. Plus you get study planner. So huge everything, isn't it? So join it ASAP. Okay? But never forget the code Y432.